open-minded, not only about music. You're very open-minded, very kind, loving guy, Errol. You better be open-minded for today's conversation, because by the end of it, you're going to know what Fed funds futures are. You're going to know what a forward curve is. You're going to know how to predict the future with futures markets. From the outset, what do you know about interest rates right now? Like, what is your working knowledge of the interest rate asset class? We're going to go deep on it here today. You don't have to know a lot. We're going to explain all the stuff here, and we're going to explain how you use futures to predict the future, or what the marketplace thinks is going to happen in the future. Interest rates just happen to be like the best place to do this. And so it's going to be the backdrop for the conversation. I want to start out with just what's your vibe on interest rates? We've traded them on the show before.
Yeah. Again, my knowledge on interest rates very minimal, but if I'm trying to trade interest rates, I know I can trade the treasury, the yields. I can trade those things whenever there's news or they're raising or lowering interest rates. I can trade the treasury yields. So that's pretty much as far as my knowledge goes for interest rates and trading.
Already great. And like, all I want is the basic idea of like, whether it's treasuries or what we're talking about today, which is like the Fed funds rate, or you're talking about euro dollar interest rates, or you're talking about, Bunds, which is German debt, like all these different things. At the end of the day, it's an interest rate. When central banks are talking about hiking, those yields, those interest rates are going to trend higher, and the prices for bonds are going to trend lower. And when they're talking about cutting, when there's economic strife, those yields, interest rates, whatever you want to call them, are going to head lower. And the prices for those corresponding bonds or notes or whatever are going to move higher. But we're staying in the world of interest rates for the most part today. And that's really all you need to know, because I want to focus just on the idea of using futures and options, just derivatives in general, to kind of get your finger on the pulse of where the marketplace is thinking the future is going. And
or it's projecting.
Exactly right. Projecting is a fantastic word for today's conversation. Now, this is a forward curve, Errol, and I don't know if you've come across this term before. It's pretty much exclusive to futures, and it presents the current prices for an asset at several dates in the future. So that,
what does that even mean, Frank?
It's one of those definitions that you have to read like a million times to understand what it's at. And I tried to word it in the most kind of like colloquial way.
How do you have current and future in the same sentence?
That's what's beautiful about this, my friend. So right now, what you're seeing, if you take a look at the x-axis, this axis down here, the horizontal one, if you're not privy to x and y axis and how graphs work, you got that one?
I passed math, yeah.
I don't know. Some people out there might not have passed math, but anyways, I got A's in math, by the way. But what you see down there is a string of futures symbols for the Fed funds futures and their corresponding expiration dates. So what you have all the way over here at the far left is ZQZ21. And that's just the December 2021 futures for this market that we're looking at. As you go across that axis, you have January 2022, you have February 2022, all the way on to December of next year, 2022. So what you have is futures markets, different futures contracts, Errol, on the same market, Fed funds futures, which we'll get to in a second, just showing you what the price is at those different dates in the future right now. And so it's the same asset class. A lot of people also like to look at crude oil. This is another good one for predicting the future with derivatives. And the idea is like crude oil right now, that's going into, jets, that's going into your car, all these different things. Crude oil has a price, and let's just call it $60, okay? But the price of crude oil December of this year, a couple of weeks from now, is maybe $61. The price for crude oil that the marketplace is projecting for January of next year, a different price, and so on and so forth, because things are going to be different between now and then. And thus you have current prices for the same asset several dates in the future. Does that definition, is it starting to kind of hit home?
Yes. Now, one question that does pop in my mind is how far in the future can we project some of these prices?
My friend, as far as you want.
Really?
So for the sake of today's conversation, interest rate futures, whether it's Fed funds or Euro dollars is another really popular one. Those tend to only go out like 7-8 years.
Okay.
You could theoretically, crude oil, I would guess, is like a few years, definitely more than a year, maybe like 3 or 4 years. But it's like a demand thing. It's the same with options, like when they open up more options expirations in the short term, or they add another one in the long term, it's just a function of like, are people going to be there to trade it? Do people want to buy and sell that thing? So, but you could theoretically, and this is the great thing about derivatives markets, you could theoretically create, an index on wind energy and be like, I want to create a futures contract for 2040 for wind. It knows no bounds. There's no defined nature. It's whatever you want.
Okay, I'm following so far. Some of this stuff is just a little new, but we're here.
Totally good. Because guess what? It's only getting newer, unfortunately. So I do want to, before getting into what the Fed funds is technically and how we can kind of predict the future of interest rates using it, I do want to hit on this fact and just really nail this home. The fact that each futures contract shifts daily, and that is going to shift the curve. So now what we have in front of you is something you're probably more comfortable with, which is just a chart of one price over time. Mm-hmm. But keep in mind, this is ZQZ2. So this is December of next year, a year from now. This thing moving up and down translates to this dot right here moving, from being up here or down here. It's essentially saying, okay, I've got all of the futures for the next year in this market. And now I'm going to put a magnifying glass on this one right here and look at how it's been acting recently.
Okay. Perfect description. Now that's what we're looking at, pretty much that dot.
Exactly right. Okay. And so back in July, if we had looked at the forward curve for federal funds futures, for Fed funds futures, this dot would be up here, and all of these dots probably, if I looked into it, all of these dots would have been up there because the price was higher back then. But since the price has come down a lot in recent weeks or months of trading, you have these prices are all kind of downward sloping. They've all moved lower relative to this one. But yeah, the general idea is the forward curve shows you right now the prices for all of the futures dates. When you choose one in particular to trade, of course, it's going to have its own back and forth. The same idea of crude oil, where it's like crude oil right now might be 60, next month might be 61, a month from then might be 62. But if you look at crude oil for 2 months from now, it's been moving, it got up to 80, it got down to 50, like it moves on its own.
Making sense. So my kind of question here is, how are these priced in? That's where I'm kind of stumped at. How are these?
They move daily as a function of just like what people are saying, what's going on in the market. They move in their own right. Like I say, the crude oil example, like crude oil, all of the futures move on their own, more or less as a function of supply and demand in the market, what news is coming out and everything in. It is kind of that efficient market hypothesis that like every single moment, the market being where it is pricing in all the information that's relevant to that market. Yeah. So I want to go a little deeper on what these things are that we're looking at, these Fed funds futures, and then show you, we're going to get back to that forward curve and show you how it is a predictive model in its own right. And I think it's going to be a pretty cool conclusion here. So hang tough for a little bit. Now, Fed funds futures reflect the market's expectations on the future path of rates. A lot of words in there, but the Fed funds rate, you may have heard of this thing before, that is what directly the Federal Reserve hikes and cuts. And so these futures markets are essentially looking at what the market thinks the Fed is going to do by December of 2022. And the way that you look at this, I don't know why they decided to do this. It's a little complex. Small exchange futures and interest rates, they're just priced in the rate, So like if the rate is 1%, it's just at, 1, you buy it and sell it and moves lower. But for all intents and purposes of today's conversation, you get the Fed funds rate by taking 100 minus the Fed funds futures price. And so when this market was in January of this year up at 99.9, that would have related to a rate of essentially 0, right? 100 minus 99.9. Yeah. And guess what, Errol? That was back at a time where a lot of uneasiness around the pandemic and whether or not the Fed was nobody thought the Fed was going to hike back in January. So this rate was at 0. Now the rate is, the futures are at 99.3. You take 100 minus 99.3, that's 0.7%. So now where we're at today with Fed funds futures for December of next year, a lot of people throughout this year went from expecting the Fed to not hike at all by December of 2022 to now 70 basis points or 0.7% worth of hiking by December of next year.
Wow.
Is that
this is information? This is like what's going on in the real world, and this is good information. Yeah. I really like how we can calculate that for ourselves too, but it just really shows the future outlook on things and people's opinions changing depending on whatever's going on today. So
the way I view it, and you and your ilk love crowdsourcing stuff. Oh my gosh. You all were going to buy the freaking Constitution the other day with the crowdsourcing and everything. The way I view this is essentially a crowdsourced source of information, right? Like, because all of this action, this market going from 99.9 down to 99.75, back up to 99.80 is thousands, if not tens of thousands of people on the bids and offers for a market going back and forth on where they think the Fed is going to act in 2022. And so like trading is sick. Taking some money, taking a couple $100 or a couple $1,000 and, investing in what you want, trading, buying the stuff you like, selling the stuff you don't like, and making some money off of it. Awesome. What you're seeing here is one of the best sources of information for what thousands, like I say, if not tens of thousands of people think is going to happen. And you can see here right now, the Fed funds rate, Errol, is 0. And why don't we get home to the kind of concluding shot here? The Fed funds rate is 0, Errol. And it came down to 0 when the pandemic hit and the Fed, it eased to try to help the economy in a trying time. We're at 0 right now in December. You can see here, this dot right here, this year. January, they're expecting 0. February, they're expecting 0. March, we're starting to edge a little lower, which relates to higher rates. By June of next year, we're all the way up to 0.3%. The Fed hikes in 0.25% increments. So what essentially you're seeing is the market doesn't know exactly when, but they're saying in the first half of 2022, they're expecting the Fed to hike. The Fed hasn't done anything yet. Okay. It hasn't done a single thing. And then by the end of the year, with the prices down at 99.30 and the corresponding yield being 0.7%, they're expecting 2 to 3 hikes by the end of 2022. That's the information that's predicting the future of what the Fed is going to do when they're still at zero, haven't done anything. We're not even in 2022 yet.
Yeah. So with this information that we receive, we can properly position ourselves in the market, I guess you could say.
Yeah, absolutely right. And so this is the kind of negative, all this cool stuff, all this information, what derivatives gets you is really useful stuff. At the end of the day, though, like Tom Sosnoff would say, it's all efficient. It's all priced in. And he's absolutely right. But what you use all of this information for, and futures in general for, and also options, it's the same with like, oh, this market has put skew, and thus the market kind of people are setting up for the market to move lower. Or, oh, it has call skew in something like Bitcoin. If you had options on Bitcoin readily available, that market's showing a lot of call skew because people are thinking that market's going to move higher. It's all efficiently priced as of this moment right now. But what's really cool, especially in interest rates and using derivatives in general, is you can look at this 0.7%, Errol, and you can then go back and say, I don't think the Fed is going to hike 3 times next year, or I think that they're going to have to hike even more, to keep up with all the growth that we're seeing in the economy. And that's when this predictive modeling in derivatives gets to an actionable takeaway, using this information where the market currently resides to then place your bets and make some money. Because you go back to the chart, and a lot of people like to take this stuff, Errol, and say like, oh, well, that's where the market is. That's what's going to happen in the next 12 months. This stuff changes, like I say, every single day. At the start of this year, people thought there wasn't going to be a single rate hike in 2022. Now, this market's all the way down here to 3 rate hikes, right? I mean, that's some pretty interesting tradable takeaway.
Yeah, good point. Because I was going to say, if we have this information, why would I be like, oh, I don't think they're going to hike rates? Why wouldn't I just listen to what the futures are predicting? So I see what you're saying.
That's where you use the information to kind of create your edge. Or, I mean, to also hedge things, like having this information might let you know, like, oh, if this is where the market looks like it's going, maybe I should buy more bank stocks. Maybe I should, like, you can use it that way. It's a little less interesting to me than to say, like, this market went from assuming no hikes in 2022 to now assuming 3 hikes. Do I personally think that this market can do this in 1 year? Do I think it can do that and then some? And that's the difference between buying and selling. Like me personally, I've been an interest rate bull here for the last couple of months since the economy recovered well from this pandemic, this ongoing pandemic. Since that economy recovered, Errol, I was like, man, interest rates should probably move higher. They should probably start hiking back to where they were prior to the pandemic. But this is a lot of movement. 3 hikes in 1 year when they thought 0 were going to occur is a lot for the Fed to do. So I would maybe take all this information and get on the short side of these rate hikes, which you can, unfortunately, Fed funds futures aren't really a great product, but you can buy or sell those chances directly with this 2-year product. It's around the same duration. It's a very similar, very highly correlated product. And essentially, if I think, and guess what, at $7, that's 70 basis points. That's 0.7%, just like we were looking at. If I think the Fed will do more than 3 hikes in the next year or so, I would be buying this. If I think that that's too much too soon, I would be selling it. And that's kind of where I would actually line up my thought process.
What is your thoughts or your opinion, not putting on a trade or anything, but like just for the rates in the next year, kind of what's kind of your opinion on things right now?
I mean, as someone who has traded interest rates, from roughly like 2015 until now, it's the thing I know probably the most about. And there you go. I got some short S2Y in there, and I'm betting on there being less than 3 rate hikes in the next year. So here's the deal, Errol. It's really, especially the recent Fed, the Fed of the last decade or so, it's been very, very hard to get them to move to hiking in an aggressive manner. They're not aggressive hikers. They're very cautious. They want to make sure if you hike, the idea goes, if you hike too much too soon, you might kind of incite some downside in the stock market. You might spook some people and bring stocks down a little bit. And so when they have hiked in the last 5, 6, 7 years, it's been like very planned and very, just like meticulous and not doing too much too soon. And that's why I think they will, all things equal in other markets, which is a huge assumption, I think they will hike a few times next year and on into 2023. That seems like the path. And I trust that path there. But I don't see them going aggressive here. It's kind of like a pendulum swinging back and forth, where the 0% for the next year or so was too much. And we were buying 2 years when it was near 0%. Now they've swung really far in the idea of like, oh, they're going to hike like crazy. And it's like, I don't think that either. So that would be my outlook.
No, I actually appreciate that. It helps me kind of think of things in a different way. Just like you kind of mentioned real quick, how they don't want to spook people. It's like, oh, wow, that's actually a good point. And I never thought about it that way either. So.
Yeah, like our parents' Fed would not have cared so much about spooking people. Okay. Like the Fed of the 70s and 80s and on, they were cutting and hiking however they wanted. Mm-hmm. Since information is so transparent, and since there are so many smaller retail voices in all these different markets, it's like we're planning to maybe hike twice next year, and we will let you know along the way if those expectations change. And so you got to take that into account. Like, I'm a big, firm believer in like my opinions on all this stuff, whether it's good or bad. They should be hiking more. They should be cutting more. That stuff, that's weekend stuff. I don't need to come on here and tell you my opinions of the Fed or of interest rates. I'm just using the facts, and that's those are the facts, my friend, for the current Fed and interest rates. How do you feel about forward curves and Fed funds futures? Dude, this was a lot today. Okay.
It was a lot, but I would say I definitely did follow 100%. Like, it made a lot of sense. And I'll give you credit again, Frank. Credit where credit is due. You explained it really well so I could receive the information. So.
Hell yeah, man. So you would say this is essentially, I went platinum, no features today.
Let's give it a few more weeks until you listen to that album, then we'll come back.
Appreciate it. Well, thank you so much, Errol, for joining me here as you do every Thursday. Check Errol out on Twitter, on TikTok, or you're probably on Instagram. You've got your own show on the Tasty Trade Network. You want to plug one or any of these things? What's going on?
Twitter. It's just fun being a part of the community. Errol_Coleman. Pretty simple, but that'll be all for today.
You did some funny stuff. You made fun of Tom pretty good.
I had to. That one had me dying. I was like, I can't wait to post this one. That squint.
Yeah, he that is like so. That's the thing he does all the time.
Unlocks.
But anyways, Errol, thanks so much. Everybody, thanks for watching us here on Small Stakes, sponsored by the Small Exchange. I will be right back here with you. Pete Momat and I are on Splash into Futures, diving into the platform, trading some futures, a bunch of trade ideas coming at you. Tune in for that. Thanks for watching, everybody. Peace.